Today I want to talk for a minute about bank failures. Obviously there's a lot in the news today about it. Banks predominantly or almost always fail for two reasons. Credit risk, which is the most prevalent, which would be what would happen with the housing crisis 2008 and 9, over leverage and mortgages and those issues, and interest rate risk, which you saw in the late 70s and early 80s in the savings and loan business. And what we've had is a prolonged period of low interest rates, and so these banks went long, meaning they bought bonds far longer out than they should have. And when their interest rates have gone up with all these Fed increases, all of a sudden those bonds are way underwater. So when you go to sell them, you have a loss. And the banks have put those in what's a bucket called hold to maturity. And if they do that, they haven't had to market them. And thus they look like they're well capitalized when they're underwater. Now this is a phenomenon that's not really in the community banking world, because most community banks have 80 or more percent of their deposits, and people have less than $250,000 and aren't worried about taking their money out in a hurry. But in banks that have a disproportionately high amount of uninsured deposits, they're much more susceptible to runs. And when you have interest rate like these banks are showing now, and all of a sudden you have to raise that money to support your base, honor those deposits, you take losses in bonds, which lowers your capital, which puts you out of business. That's what it's all going on right now.